Time for the large conversation on Talking Point. Vikas Prasad, Portfolio Manager, Asian Equities, M&G Investments, joining in this morning. Vikas, very good morning to you, and thank you so much for speaking with us. It's always a pleasure. Let's start with something which has been on top of mind for markets. I'm wondering whether you think the AI scare is overblown to some extent from the Indian market perspective, or is this a problem that is going to keep dogging momentum as far as Indian equities are concerned?
Good morning, Tamanna. It's good to be back. Good to see you in the studio, not in the snows of Davos. I was in the studio the last time we were there. On the AI, as you know, we are long-term investors. We're very stock-specific. However, we do think that these AI headwinds are quite real for a large portion of the Indian benchmark. We have remained underweight the IT services sector throughout 2025, to start 26, and also now. There are some small and mid-cap companies in particular in India that have been, we think, unfairly punished. Some tech platforms, some IT services that are listed in India but have a majority of the customer base abroad, but are very different from the heavyweight benchmark components that everybody is focused on. So again, we are seeing opportunities in this. There are some stocks that are down 20 to 40% just in February, as this SaaS apocalypse, as some people are calling it, has taken root all around the world. But if you just focus on the IT services sector, the revenue headwinds are real. The cost structures are still high, given what might happen or the revenue opportunities that we might see in the next couple of years. So we remain underweight the IT services sector here.
You're underweight IT services sector, and everything that we're hearing and seeing from all of these companies to convince investors that they are going to be AI ready, the deals that they're cracking with some of these large companies, whether it's Anthropic or OpenAI, these partnerships, not convincing you, Vikas?
It's a little bit too little in the short to intermediate term. These things will take time to play out, but it's not just about the revenues. And some companies did have healthy backlog growth or order book growth in the most recent earnings season. But when you look at the cost structures also, some of the companies have issues there. It's hard to identify operating leverage to come, positive operating leverage to come. And then there's a question also of what do you want to pay for a business like this or businesses like these today? Many of these companies are trading at the lower end of their forward PE multiples in the post-COVID world. But if you look at them, many of them are towards the high end of the decade prior to COVID, before tech spending really took off when everybody was sitting at home. And we're looking at things not just in the 2, 3, 4-year context, but over the last 15 to 20 years as well. What I should add is we're very aware that all these companies that have been listed since the late 90s, early 2000s, have reinvented themselves many times. After Y2K, after the GFC, during COVID, and it's possible that they can do it again. But this environment is different than what they have had to deal with in the past.
Because sorry, extending that point further, but and good morning to you. But could it well happen that it will not be a single shade painting all companies, and there will be some which could turn out to be winners, and there will be some that turn out to be extreme losers in this wave? So net, could selective bottom-up value buying happen within the IT space? Are you also doing that?
Yes. So yes to both of those questions. There will be some dispersion, or a lot of dispersion, actually. And we see more opportunities for now beyond what are traditionally called the IT services companies in India, but tech-based companies that have genuine moats. There's a lot of work that we have done and others have done also to identify what really is a moat in this AI world. Having proprietary data is a very big moat. And companies that are integrating the APIs from various LLMs, from various world models over time, they have an advantage over simple or simpler transaction processors that don't have proprietary data. And over the past 2 weeks, we have selectively added to our holdings where we think that there are moats, with the proprietary data being a big driver of that.
Okay. Because the other thing is this almost lackadaisical move that we see, and not just for 2026, for better part of 2025 because of FI selling, that was indeed the case. But no matter what the trigger might be, no matter how solid the macro may appear to be, no matter the fact that Q3 was not a bad quarter, in fact was a pretty decent quarter, there seems to be this lack of follow-through buying happening despite the SIP flows continuing. What will it take for the markets to start performing? Or do you believe the headline Nifty may stay stable and it will be specific pockets only that will show performance in 2026?
Well, there's two parts of my answer. First, when I was in the studio last month, it was just before my trip to England to meet a series of clients, and the feedback was actually quite encouraging on India. This time last year, I met many of the same clients. The question seemed to be, why India? Now, after near 50% repricing of India related to relative to other emerging markets, it's now become, why not India? And our response was that the drivers of this market had made it the best performing market in the world for about a quarter century, compounded at about 14% a year in local currency terms for almost 25 years. Those drivers remain intact. Meanwhile, we've had this material reset in pricing relative to emerging markets, so that's helpful. But it will always be stock specific. It will be a good home for active management. In the short term to medium term, it's hard to see the flows reversing. Yes, we've seen more buying by FIs in February, but you look at the Korean market, going back to Liberation Day last year, the KOSPI2 index has tripled. It was up 90% last year. It's up another 50% just year to date in 2 months. This is the overall index. And we've seen a lot of companies that are part of the AI supply chain that still do not look demanding on valuations go up 100% to 200% year to date already. And when you have that opportunity set available in South Korea, in Japan, in Taiwan, it's hard to see investors rushing back to India. But stocks follow earnings. India for a long time has been the highest growth market in the world by in aggregate, and then by sector after sector. And we see that remaining intact for the next couple of decades at least.
Vikas, what are you then spotting in the Indian equity ecosystem right now? Is it time to look at non-IT, non-AI disruption kind of businesses, more maybe EPC, infra facing companies, and maybe consumption? Is that something that you're finding interesting? What really are you looking at right now from an Indian perspective?
That's a fair question. And to your point, we've seen a lot of positive developments that should be supportive of the Indian market over the past month. We saw the EU-India trade deal, the starting of the US-India trade negotiations, and that deal as well. I thought that the budget had some good things for long-term equity investors. Yes, there's some noise around capital markets and trading-related companies in the short term, but that has proven to be an opportunity. We are overweight in healthcare-related names, very broadly defined. That includes services, that includes medtech. I would encourage investors to spend time on healthcare services here. That's a largely domestic story. You have in India a market that, in a world that is increasingly interconnected and linked, has over 70% of revenues for the NSE 200 coming from domestic sources. And that number is growing, whereas for the S&P 500, the number is less than 60% domestic revenue. That number is falling. So you have a lot of very domestic stories. Healthcare is a good place for that. The manufacturing story is a good place for that. Auto components, looking beyond the two-wheelers and the CVs and the four-wheelers, where we do have exposure, but in the auto components sector as well, there's a lot of opportunity there. That's a broader and deeper universe of companies than I think many investors realize. So healthcare, manufacturing, defense is still interesting to us. There's been some volatility there this year, but on the long-term view, we remain constructive on defense, just as we have been for the past few years. And it's not because we have been, we're looking forward and we see opportunities in defense as well.
Defense, would you say that some of the core defense names are not overly valued and more opportunities exist? What are the kind of defense companies you're looking at right now, Vikas, and same for auto anchs?
On the defense side, less software, more component companies, and there's many of those. I'll be visiting some of them soon in India. India has the largest and most liquid and deepest pure play defense ecosystem in Asia. So there's a lot of opportunities for investors there. I do think that earnings estimates on a 2 to 3 year view remain low compared to where they will be relative to earnings delivery for the next 2 to 3 years. And this is up and down the market cap curve. And you asked about the manufacturing sector.
Auto ancillaries.
Yes. So we're going to see domestic demand as a key underpinning of the earnings growth here, but we're also going to see more export opportunities, more international related demand as well for a lot of these companies. And yes, over the past year, especially going back to Liberation Day, many of these companies have done very well. But relative to where they will be, a lot of these market caps are still very small. The valuations are not demanding. On the IPO front, we're seeing some high-quality IPOs come here. Last year, we only invested in 3 IPOs out of the near 400 IPOs that there were. And 2 of them were in the healthcare space, and 1 was in the auto ancillary space. And so we continue to like both of those.
Vikas, did you play the commodity upcycle via equities, and are you still inclined to play it?
We have had exposure to that over the past 2 years. We have had exposure to cement, to steel, to aluminum and copper. Cement is one area where we have lessened our exposure in recent months, but we still have exposure to other parts of the commodities cycle. If you broaden the conversation and you look into construction, building materials, that's also another area that we're spending time on. This again is a very domestic story. Someone I was asking earlier about infrastructure, CapEx. If you look at pipes, cables and wiring, those companies have done well. The multiples might look pretty full on a 1-year view, but we are doing our work there. And perhaps next time we can talk about some newer exposures in those sectors. But for now, yes, we still have exposure to the commodities, steel in particular.
Okay. So continuing that exposure, if you will. I presume, Vikas, what you're also trying to say is that stocks which benefit out of copper, zinc, etc. rising, selectively you still have exposure and will continue to have exposure to them.
Yes, I should highlight that we have very strict filtering mechanisms for sustainability, for coal, and all that. But yes, we like what we own in the commodity spaces.
Very interesting. Okay, great. Vikas, lovely talking to you. The next time we'll broaden this conversation, as you said, hopefully maybe in our studios. But thanks so much for joining in today.
Thanks so much.